Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Monday, March 24th, 2025. It's 1:05 p.m. Eastern Time as I'm starting the video. Figured I'd do at least one more today since I'm going to be out tomorrow, possibly Wednesday. Again, don't know if I'll be fully back online Wednesday or not. So wanted to get everything out to you now. I figured get these videos. You can watch them at your leisure. This one is not as much a timing indicator. Although I just want to reiterate what I said in the earlier video. I personally don't trust a bear market rally as far as I can throw it, but I want to speak a little bit more on that because I said, look, we can't really say we're in a bear market. Technically, it's only been a correction so far. I'm going to go over some of my long-term indicators here. I'm also going to go over some of my breadth and sentiment indicators that kind of both paint the bigger picture and then the near-term picture. And I'll tell you in a nutshell what it is. The sentiment indicators, although you could certainly, if you turn the TV on or read the headlines over the last week or two, yeah, all the bears, the analysts and economists that come crawling out of the woodwork that were calling for a great 2025 suddenly started to ramp up the recession drums and this and that and the other. And like I told you, all it takes is a 10% drop in the market to quickly change sentiment. Now, what I'm going to go through here is there's two type of sentiment measures that I use. Those that are in rhetoric, in other words, people say they're bearish, or there's even a survey that we'll cover. And those that put their money where their mouth is, and that's the put to call ratios and things like that. So I'll get to that one second. Let me just start with the bigger picture, because I made mention in the last video that one of my favorite long-term trend indicators. I have a whole bunch. I have a whole different set of charts with different various trend indicators, but a very simple and effective one. Let me turn off all the lines here. Is this dashed blue line, which we're on a monthly time frame. That means every candlestick is 1 month of trading history. This is SPY, and that line is the exponential 20 period moving average. So it's a 20-month moving average exponential calculation, and I've used it for years. You can go back as long as you want. You can see that blue line. It's a if I were to rank any indicator on a scale 1 to 10 with a combination, there's two components to any indicator, both the accuracy or effectiveness and then the simplicity. I mean, you can get complex as you want. Some traders use pairs, 2, 3, even 4 different moving averages crossing over and doing different things. You can get as fancy as you want. So I put a weighting on simplicity. And again, what's more simple than looking at a single moving average and just seeing if you're above or below it? I talk about the 200-day moving averages all the time, but on this monthly chart, that's it. And you go back into the 80s if you want, which we're doing here. That's as far back as SPY goes. Remember, SPY is an ETF, so that's where it started back there. You can plug in the S&P 500, you'll see the same thing, but you'll have longer history to do it. And this was that was certainly a bear market, a drop of I don't know, doesn't look like much. Remember, we're looking at log scaling and we're looking at decades of price history. So when you see a blurb like that, that was close to 20% drop. But again, let's keep it pretty simple. Just look at the line. When you're above it, this is what I kind of call my 401k indicator. If you want to you have a timing indicator for your 401k. If you were to do that, where you're either in or out of equities, this is it. And so by following this, even if you took the whipsaws, remember it's a monthly chart. So all that matters is how a candle closes at the end of the month, not intermonth. That helps you avoid whipsaws on any time frame you're trading. Look at the at close of that period. And so if you took this, it would have took you out right there, put you in a couple months later. You would have caught 99+% of this entire. That was one of the, up at that point in time, probably the strongest bull market in history. That was leading up to the dot-com bubble bust. We had a roaring bull market in the 90s. And then right here where my crosshairs are, you took it out, and it would have got you not only out of it, you would have made a tremendous amount shorting once you took that signal and took out all equities and then shorted rallies back to the 20-month. And you would have captured, I don't know, what is that, maybe 80% plus of the either sidestepped 80% of the losses, and I'm just eyeballing it, or actually turned around and put that to your advantage and short it. So, a lot of people fear bear markets. I embrace them. I see just tremendous profit potential in bear markets, just like even better because bear market stocks, I always say, fall faster than they rise. So in 2000s, late '07 to early '09, 18-month period, you wiped out gains that took you in the stock market over a decade to make right there. Goes back to the mid 90s, and that just happened there. And that's not unusual. The thing is, bear markets are pretty real bear markets, these 50 plus percent, 30, 40, 50 plus percent drops are relatively far in between. COVID was a bear market. It was over before you knew it, but it was a 36% drop. And so was this drop off the 2022 highs. So again, the takeaway here is, you'd struggle to find a more accurate indicator and one that's as simple to use. So keep that in mind. We're above the 20-month now, caught all of this move. And not only that, it's one thing to say, oh, I missed the signal. No, once you're in a bull trend, you just buy pullbacks to the 20-month. And that would have served you extremely well here. Even if whoever you are, unless you're in retirement, if you're working, you always have capital to add. Even if you all in, even if you took the signal and at that time moved everything back into equities and bought it back there. And again, I'm not sitting here preaching an all equity or all out portfolio. You can take that as you want, reduce equity exposure, increase it. Either way, hard to argue the effectiveness of this trend indicator going back decades. And there are whipsaws. There's periods of volatility that was coming off the financial crisis, end of the financial crisis, excessive market manipulation by the government. And but either way, you can see there a couple. Again, this was a Q4 2018 drop, 20% from the highs right there to the intra-period lows, 36% in COVID. And then that last bear market. So, all right, let's just end it here. Now, there's more takeaways from this chart. So we are above that. And the way it works is I've had some check marks recently. We're below the 200s, back testing now on the NASDAQ 100, other things like that, trendline breaks. But the odds will go up substantially when I see a solid monthly close, meaning a red candle that I don't have to squint to see if we're above or below that line, one that clearly closes below. That'll be and what I call an additional and a big check mark for my bearish case. Increase the odds that my longer term targets are going to be hit. A drop of about 40 something odd percent in the S&P 500 and 55% or so in the NASDAQ 100. All right. Now on there, okay, there's a lot more on this chart too. Turn back on the lines. Well, before I turn on the lines, a very effective trend indicator on many time frames, and you have to study each security, each index differently. It works better on some than others, is simply a bullish and bearish PPO crossover. So this is a high level above the zero line right there. In fact, that's what this histogram, see the green and red bars, they show you when these lines cross. So this is your PPO line, the blue one. This is the PPO signal line, the white one. So when the PPO line crosses down below the signal line, the histogram will cross red. So that shows you exactly when it crosses. And that you might say, well, that wasn't much. That was actually we call it a deer market, technically, neither bull nor bear, but it was pretty much a bear market. A bear market is just defined. You can take the antiquated 100-year-old definition of a drop of 20% or more off the highs. Again, antiquated in this day and age of excessive market intervention, easy money policies and all that. They've supersized everything. It's like, if you ordered a cheeseburger or a Happy Meal from McDonald's or whatever it is, 30, 40 years ago, that was it. You had one meal and it came with a hamburger, Coke, and fries. You go in today, you can supersize it for $1 more or whatever it is, get a giant quart of Coke, giant tub of fries and all that stuff. So the Fed has supersized the cycle, the magnitude of moves in the market. Not just the Fed, all the global central banks, as well as, and that's monetary stimulus. And then you also have the fiscal stimulus. You had the Biden administration going full court press on fiscal stimulus as if we were in a recession. It was the first time in history. I mean, fiscal stimulus is typically reserved for recessionary periods to kick up, stave off the recession and try to spur economic growth. And so what this, previous administration did, and Trump's probably the same way and going to do the same thing, is just stimulus. They just want the market up no matter what. So they kept the gas pedal, to the red line and hit nitrous oxide, even though they were winning the race by 2 laps. So it's that kind of thing. And so I think there'll be a big price to pay later on. And I think that price has probably started. We'll see. But hold on. Let me just get back to what I was talking about here. So this is it. Go back in time, and you can just look and check out these bearish PPO crossovers. You had one right there. You can see, just look at the histogram. I'm going to just draw that up for you. And I encourage you to do this on your own. Look at bullish crossovers is when you want to get long. That's a buy signal. And again, I'm looking at the histogram, which is also these two lines crossing here, but the histogram shows you exactly where. And that was, a double-digit drop there. You had it was a whipsaw. You had another high. You did cross there, and it didn't signal the end, but the end was shortly after. So basically, when you look down below, these red periods, these red hills below, signify a bearish trend. And the green hills on the histogram signify bullish trends, right? That's what I'm boxing in. Bearish trend. I might have overcut that a little bit, but you see what I'm doing. Bullish trend. And most of the time, stocks go up, so you're in the green. But again, you want to take a look at these red, especially, guys, this is a thing I've noted too. When you get a little whipsaw, I like to see big green hills. That's when you want to see the crossover. And that one was a whipsaw. This was a flattish, sluggish market. But look, you also held the 20-month. So use these in conjunction. The more indicators you can use together, the more accurate your timing, they're going to be, the signals, the buy and sell signals. So on this one, this was the first red bar on the monthly right there. So imagine back in the financial crisis, you sold all your longs out of your 401k and you turned around and shorted instead of, like most people, suffering a tremendous amount of monetary and mental pain. That's 50 plus 55, 56% drop. You turned around, you either sidestepped it or you profited from it. And then it said, get back in. The water's safe to get in now. The sharks are gone, and that's it. So you had a little, not even a whipsaw, because there was a drop there and you went below, but then you recovered it. So again, even if you take them on face value. So let's fast forward. You can see it all there. This was that bear market, and we were short, not far off the highs. Usually we get our sell signals first on the 60-minute charts and daily charts, but I'm just going to encompass that whole red trend period there. And it didn't get you out at the lows, but there were other reasons: positive divergences, breakouts of downtrend lines, and pullbacks to support, price targets being hit. And so this has been, since the PPO has been bullish. Now look where we're at. And now it doesn't take a full-blown expert in technical analysis to see what's likely to happen soon. Remember, there's next Monday is the last trading day of the month. The 31st of March will be Monday, this next Monday coming up. So we'll see what happens, and all that matters is how this closes a month. So if we get, if between now and Monday, if the market falls, remember, this also shows momentum's waning. It looks like, relatively speaking, the market hasn't fallen much, right? It was a 10% drop so far off the highs on the S&P 500. But what happens is the PPO is a trend indicator. And this is what a lot of my trading looks at. This is why I anticipate things before they happen. I look at momentum indicators. That's why I use divergences so much, positive, bullish, or negative. And that shows you that, yes, you are in a downtrend, or yes, you're in an uptrend. But however, it starts to show you when the momentum starts to waning, meaning the buying pressure is drying up, the momentum is drying up. And you can see the PPO, look at the PPO lines, clearly crossed down. And again, it doesn't take an expert technician. If you had to guess, where in a month, 2, 3 months, is this line going to be? The PPO line going to be above or below the zero line? There are no guarantees. Sometimes they look like they're going to cross and they kiss. But quite often, once it turns down and it's headed that way and you're about to cross, you're going to get the crossover. Again, most points in time, you can play around with it and look at it and see here's a period where you could have got the cross earlier. It kissed for a couple months right there, meaning the lines flattened out, and then the crossover came, and then the red histogram, although you would have wanted to use other sell signals. Remember, I've given you I've had a plethora of sell signals trigger one after another, from 15-minute, 60-minute charts, then the trading ranges we were in, then the 200-day moving averages. So I already have a lot of check marks. I'm just telling you, this will be a big check mark for the longer-term outlook. And in my opinion, the odds will rise significantly that my longer-term targets are going to be hit on the S&P 500 and Nasdaq 100. The other thing, again, the crossover will come. You can see right now the histogram bar is flat. It's at 0.13. And when it goes to below the zero line, that's when these two lines cross. So there's an example, by the way. It looked like you were going to have a bearish cross, but they didn't cross. They bounced, and you never got the sell signal. It kept you long, at least again on this indicator. Now let's look at QQQ. QQQ has made a cross. We are not, the month is not over, but as of now, you do have a crossover. So on Monday at 4 p.m., that's when this candle finalizes, the monthly candle. And if that's red, that's going to be a check mark there for QQQ. All the better if you have a red histogram bar on SPY as well. And so, I did the video earlier today. I told you I've started to scale back into shorts, and I gave you my preferred and maximum bounce target. I don't favor us going to the max bounce target. That's why I have a preferred lower. And I'm also very open to the fact we may not even, possibly not even get there. I told you before, I'll welcome and embrace bear market rallies. Somebody asked too, since I'm going to be out tomorrow, I mentioned I've got to do some surgery, and it's actually a city away. So they said I may not overnight in the hospital. Depends how it goes. Either way, I'll be back tomorrow. On Wednesday. Don't know how I'll be feeling. I have no idea. So if I'm good, then I'll start pumping new analysis out. But I want to do this video now before I leave, show you levels to watch and all that. And this is kind of bigger picture stuff. Because again, no matter what happens between now and next Monday, it really doesn't count, if you will. However, again, when you look and you see these histograms or just the slope and the angle of the line turning down, here's a case where it looked like you maybe would get across, but we weren't as close and we didn't cross yet. And we had a little last hurrah there, and then the correction came right there. And you did print 1 month below. That was the Q4 of 2018, big drop there. We milked every penny, reversed it off the lows. That was the first time the Fed tried to pull away the punch box, or the punch, from the table, trying to cut and raise rates, take back, get off their zero rate policy. And as predicted, the market threw a hissy fit, and Uncle Powell cowed down and said, "Okay, I'm sorry, we'll take that away. We'll stop trying to raise rates," and went the other way. And then you can see just beautiful little prints right on. That was a green candle above. So there it is. Watch that. And wait for that, see what happens on Monday, see what happens with the S&P 500. Like I said, probably going to see a little more upside before Monday, and then a reversal would be my best guess as of now. And somebody asked, hey, if you can, bring your iPad to the hotel and all that. I said, look, to the hospital. If I can, I will. I'll bring a laptop if I have to overnight, and I'll look at if I can get something out to you. I said I'm not going to put out a fuzzy-headed post I don't know if I'll be on any painkillers after that, but I will not risk putting out a post for the sake of putting one out if my head isn't 100% clear. I just want to let you know that. So could be until Thursday or so before I start resuming posts. That's it. So there's QQQ. Let me just, for kicks and giggles, look at IWM. IWM, you can see the lines, the PPO turned down, poised to cross below the signal line, and just depend. And the histogram bar is right there, 0.01. So that's the state of the on the markets right now. And the question is, sometimes they do kiss. So if you want to just play it safe, wait to see the cross. I have a pretty high degree of confidence it'll probably happen. If not, we already have it in QQQ. QQQ would have to rally quite a bit, and it could do it to prevent that intra-month crossover we have right now. But again, to me, it's inevitable whether we get it this month or next. I think we'll probably get it this month, even though we only have till Monday to get that. And if not, next month. Now, the thing about that, too, let me just speak to that real quick. Okay, let me go back to QQQ. So let's just say hypothetically, park right on there. And again, I don't want to put too much weighting. This is just kind of giving you the bigger picture right where we're at. So hopefully that lets you know my mindset as to where I'm at and why I'm looking at most we're going to get a bounce. And I also don't try to get cute. I'm not trying to milk out that last little bit. As I told you, I started hedging up yesterday with VIX calls, going back into the VIX. and then today started reshorting a lot of the stuff that I had closed out in reverse long, and wouldn't be surprised if today's highs mark the end of the rally. It's just how bear market is. I'll show you that in a second. You could just look at any major top, and you can see normally afterwards that the first down is pretty heavy before you get a relief rally. We're not that much off the highs. But what I wanted to show you here is that, let's just say that SPY and IWM I don't care much about. That's, as far as moving the markets, the large caps make up most of the stock market. Even though there's fewer of them, there's just a lot more money, and they have a higher weighting on the overall market. But if we did happen to, let's say, stick save it here and get a little green histogram bar, my guess is next month it'll probably be a hard down. And then if you wait to the end of the month, well, you could be, the NASDAQ 100 could be down here by the end of, it could, in a month, it could easily drop that much or more, 20, 25% in a single month. So just keep that in mind. These are not exact timing indicators. They're just kind of the bigger picture where we're at on that map, that roadmap of where we're likely going. Okay. And just to recap, as I did in that previous video, just measure that, when the Qs peaked back, the NASDAQ 100 peaked back in the fall of 2021. Before all said and done, we dropped 22% before the first counter trend rally. And that counter trend rally, almost to the button, ended on a kickback to the 200s I covered before. The first, we had a little kickback rally to them, then the second one, and then you can see selling starts to accelerate. Remember I talked about the POR? That was the POR back then, the point of recognition. When the markets, bulls thought that, okay, great, they took back the 200 exponential, they'll probably take back the 200 simple, then we're off to new highs. But they realized when they got rejected, and once these lows went, boom, that was it. And then every rally kept getting sold into back at the 200s until they finally took the 200s out. And the technical setup, with the divergent low and all that. Okay, and a lot of what I wanted to cover in this second video today is what I'm seeing, or more importantly, not seeing from a sentiment perspective. So we're going to talk a little bit about sentiment now. So the VIX Volatility Index is the methodology. It's based on put and call buying in the S&P 500. The VIX itself is typically range bound. There's no hard bottom. Zero would theoretically or technically be the bottom. It never goes to zero. This is a weekly chart, so I'm able to go back all the way into the mid 90s here. And I've covered this chart many times in the past. This is my previous bear market end zone up until this period here, up until the financial crisis. That's where bear markets ended, including the dot-com bubble. There was the bear market. Remember, the market peaked. The NASDAQ 100, which was the heaviest hit, peaked in March of 2000, just after that. And the VIX had an initial spike, but they didn't believe it. The VIX had another spike. It took it to get to this level. That's right about when that bear market ended there. I think it ended in early right here, early 02. This was so that second run up there. So you can see again, this is where big corrections and bear markets ended. That was the Asian contagion in 1998. Some of you may have been around, others don't, but you can look at the charts and see that correlates with that. And then we went up and hit a new low, all-time low in the VIX. Sentiment was just, everybody was super bullish. So fear was falling, but it was set up just like the stock market in reverse. In 2007 at the highs, we had big negative divergence, and very few believed a big bear market was coming. But I was one of them, absolutely. So I even walked away from a good career as a stockbroker, financial advisor, working for a big bank system because I was in the banking system, a fully owned subsidiary of worked for several regional banks, was an officer of the bank, sitting in the meetings. I knew, and I was in ground zero of the housing crisis, so I could see it all coming clear as my hand in front of my face. And so it was a very profitable bear market to trade, and it was priced into the charts as well, besides the fundamental analysis. Watch a movie Big Short, and they sent the team down in Florida. Like I knew that was going on at that point, because I was knee deep in it and listening to the commercial lenders and especially the mortgage loan officers telling me the liar loans that they were doing because they were told to do them. And anyways, it's all history now. And it's this time around, there's different similar but different things going on in the markets. All right, so what I wanted to get to again is the VIX. So this is pretty much two spike lows historically, but this has typically been the bottom of the range. And that's what, back here highlighted. We highlighted the VIX. We've had several long trades on the VIX, and it's been popping, popping, popping. But what I want to point out is since the the double aughts, 2000s or late 90s to early 2000s, this is where bear markets ended. There were two, some might even call what we had in 2022 a correction, bear market, the old 20% rule. If you're going by that, it was a bear market. But this is where the financial crisis ended. The VIX peaked in late 08 when the NASDAQ bottomed, the S&P bottomed in March of 09, right before that. And this is COVID right there. So you had two almost identical peaks. And that's where bear markets have ended. And this is my bull market correction level that I've had here where bull markets have ended. And so that's, bull market corrections. And so that's all that 2023 feels. Or here was 2022 right here. This was a recent spike. This one was back in August of last year. We had that one spike up, brief spike there. But you can see recently, this is what I'm trying to show you guys. This is it. I mean, we haven't even hit where corrections end yet. And so technically we just have a correction. So is it over? Is that 10% pullback in the S&P 500 it? Whatever it was, 12, 13 in the NASDAQ 100? It's possible. I'd be a fool to say otherwise. Anything's possible. Is it probable based on this? No. Because there just wasn't enough fear. No matter how bearish the folks coming out of the woodwork on TV were and the articles and all this, this is, there's two types of sentiment indicators I've mentioned before. Those were, what I call rhetoric indicators. The AAII, we'll get to that in a second. It's a good one. The American Association of Individual Investors. It's a weekly survey of their participants. Are they bullish or bearish going forward? And as I've said many times, they can say that they're outright bullish or bearish, screaming bullish, bearish. And so they intend to buy or they intend to sell, but then something can change their mind. They don't have to do it. I might say I'm bullish and I'm going to buy, I'm going to load the boat on Tesla, let's say, or QQQ. But then something changes my mind, I don't do it. So there's a big difference in that one versus the put to call ratios, which are an actual measure of people putting their money where their mouth is. And the VIX is a function of that too. It's based on put and call buying. And so you can see here again that the VIX, we certainly had a nice pop in it recently, as predicted. I told you the VIX was cheap here. I use that word exactly, on sale, very cheap. And we had a nice run up. And the $1 million question, is that it? And I don't think that is. I think there'll be another leg up. 106% rally so far. That one was 372. We were long right there at that low. We were long at this low, and so forth and so on. So I just wanted to point out that by this measure, even though that's 106% pop, that's nothing for the VIX. Remember, everything is relative. Look at the scope of the previous moves. And so this is it. So if again, maybe it was just a little correction, a big buying opportunity, but the fact that we're below the 200s, we dropped below the trading range, we're coming off those big divergent highs, I would say that's more the initial shot across the bow. Before this bear market's over, I think we'll probably even exceed that level if we hit my longer term downside targets. But this is the next big resistance. If we do get another drop this week or next, that's resistance on the VIX. Then about 50.37. That one's I have around 36.72, 50.37, and then this level here at about 88.68. Okay, I'll rifle through a few of my sentiment indicators. This is that AAII bull-bear spread. So the histogram you see here just measures the spread, or the differential between the percent of respondents that are bullish versus those that are bearish. I've covered it many times in the past. This is the red level, is where you have extreme. It's red because everybody's bullish. It's a contrarian indicator. So when you hit this level, that's usually tells you everyone's bullish. But as I've commented on before, these are not timing indicators. But if you are to use this as a timing indicator, and I did talk about this just a few months ago right off the highs, and I was actually prompted by a member who said, oh, well, we flipped to bearish. Everybody's bearish now. And I went in and actually then covered that in the next video saying, thanks for bringing that up, because that is the timing indicator. After periods of extended bullishness, it's when you flip and then people start getting bearish, as I pointed out with all these dotted lines here. That's when, after the extended period of bullishness and everyone starts getting bearish, that's when the top comes, right? And it happened there. It happened right there. You take the arrows down. You can see my dotted purple arrows. These were all the biggest corrections in years, if not a decade or more. That one too, there was the financial crisis back here. But that was it. So it was the fact that sentiment started getting bearish, and you might say, well, again, from a contrary indicator, and there's two takeaways. I've always said these sentiment indicators are completely useless, less than useless, because they'll give you false signals unless you pay attention to the extremes. Now, that crossover is a flip in sentiment, but that's all it was. And then you had another relief rally. You went to new highs. It crossed right there. The market went on to make a marginal, slightly new high. Everybody got bullish on the new highs, and then boom. And that's where we're at. So we now have hit the bottom level. You can see this is where things start to get sentiment hits the extreme bearishness. So yes, from this, everybody did get extremely bearish recently, but what happens, especially in a bear market, you have these little relief rallies like we're having right now. Everyone will get bullish on a rally. All it takes is a day of a 2-3% gain like today in the stock market to make everybody all of a sudden bullish again. Crazy how it is. It's a short-term thinking mentality, but you can see it, you get these periods, but then you stay persistently down at the end of that range until the move is over. So based on a lot of things I've seen, there's still more downside to come. It's just a question of how far are we going to rally then. And again, if something else different happens, I'll let you know. The levels, I covered it earlier today, where I start to change my mind of whether the market's done. Not the recent highs were the highs until we go a lot lower, or are we going to be able to make a new high? And one thing I always harp on is ability to stay flexible and not become married to any one scenario that the market must do this or must do that. About one guarantee I'll give you right now, of all the politicians that I know, I've known in my life, I can think of none other who are more likely to pull out any and all stops. There was talk of Trump, trying to bend, have Powell take bended knee to him on his last term, and he's already thrown out now, and you see him firing appointees in pointed positions. And so, there's that again. We all know it. He's, going to pressure Powell to cut rates, and if you don't cut, so there's, in other words, what I'm getting at, there's not a single extreme measure that I won't see this, that I can't imagine this administration won't take. I'm also a believer at the long-term charts. I've talked about, excesses have gone on for too long, things building in the charts, and nothing can go on forever. We've already had a tremendous amount of manipulation to bring prices and create the bubbles that we have, the AI bubbles, the tech bubbles, massive amounts of money given to these Mag 7 stocks to buy their stock back with financial engineering. All that's already occurred. So, you get you get to the point where you get a point of diminishing returns for fiscal and monetary stimulus after such an extended period of it that we already had. The Fed had every opportunity in the world, and so did Washington, D.C., to reduce stimulus in the markets, both fiscal and monetary, and they didn't. They kept the pedal to the metal too long. So that's kind of it. So either way, I'm just showing you where we're at now and talking on this and how this might play out, this sentiment indicator. But let's look at a few more now. This is a CP, total put to call ratio. Years back, I played around with the moving. I just figured I'd try this one. It works pretty well. It's a 100-period moving average, and I just figured where I have a line here. It's kind of not arbitrary, so it's set based on where I can see its support. You pull back and it's support in a bull market, And then when you cross below it, and usually you're below it there, that's where you get. We haven't had a lot of bear markets really in the last few years. I just want to say that that's what it shows is the put to call ratio has been declining. That's what a 100-period moving average will do. Any moving average will smooth out all the irregularities and kind of show you the trends. That means we can see the trend going down there. But my favorite's really the CPCE. I think it works better than the total put to call ratio. CPCE is the equity only. So this is, again, unlike the AAII, which is a what I call a rhetoric sentiment indicator, meaning just what people are bullish or bearish in rhetoric versus their actual positioning. This is actual positioning. You can't fudge this. You buy a put contract, it goes on here. You sell one, it goes on here. And so it's a ratio of put calling to call buying. Yes, a good part of all options, are hedging, but that's also factored in. It's just so what you want to look at are extremes, and you can see these are the extremes where the put call ratio gets very high, and that's bullish. Means there's a lot of fear, and you can see we hit my green zone, hit it again, boom, boom, boom. And had then one big correction since the last bull market started. After the last bear market, the last correction. Forget about that 14.7. That must have been covering that during the drop, saying we're only down 14.7, more to come. And that was it. So we had one nice correction. We hit that level. These were all buying opportunities, and you can see we're not even remotely close to any fear in the market based on this indicator. Again, don't listen to what the bobbleheads on TV are talking about. Don't pay too much attention to the headlines. This tells me that again, the money where your mouth is, positioning wise. This is all we've gotten so far. Since there was the peak right here, since the long-term chart, there was a peak in the market. We hit my red zone, which I did highlight right before then. The red zone is when you have extreme bullish sentiment. This means the put-call ratio falls to levels where there's just virtually no fear in the market. Everybody's bullish, buying a lot of calls, very few people buying puts. And then, boom, the big drops come. We had one right there. That was COVID. Then we had a little surge there. Remember, COVID was a very wonky, unusual, extremely unnatural period in the financial markets where so much fiscal and monetary stimulus around the world, every government, all the big developed countries, all the central banks, just thought the world was going to come to an end. They hit the nuclear button. So you had massive distortions in a lot of things. Price discovery as we know it in the financial markets was thrown out the window. You couldn't count on bonds as given cues and everything. But everything's kind of normalized, and then you hit it again there right before the top, right before that bear market. And then most recently we hit it again there. And so this tells me more to come. And again, if I saw this right now, I would be most likely I would have higher bounce targets than I do. This just tells me, again, very little fear in this market right now as per this metric. Let me see if there's any others that I need to cover with you. That's the same one. Nope, that's CPC. That's the total put to call ratio. I think that's it. Yeah, there's the bull bear spread. I already covered that. Okay, we're good. Let me move on to the next one. Breadth indicators, which kind of show you the internals of the market. One of my favorite I've used for many, many years, the NAAD. That's the NASDAQ advancing versus declining issues. And so that up top, you have the NASDAQ 100 right here. And down below, the NAAD. And so in a healthy market, you should, as logic would stand to reason, you should have more issues advancing or going up at any point in time than going down. That's a healthy market. And that's what you usually see, especially at the end of bull markets. There was the financial crisis right here, 56 or so, 57% drop right out of the gates. It was strong. And then you start diverging. You can see all my divergent highs, and then the corrections follow. This is divergent high, correction, divergent high, correction, divergent high, correction, divergent high, correction. Divergent high, correction is highlighted back then when we had that last bear market in 2022. And now we've been building divergence. In fact, the divergence really starts, again, I consider this a continuation, just an initial leg down with a marginal new high of a much bigger drop, but the divergence has grown on every indicator I've looked at. And you can see the NAAD just falling off a cliff. And what this is, guys, and you're probably thinking this, yes, it's a function of 7 or 8 stocks doing almost all the heavy lifting in the last few years, both because they had just incredibly dominant, almost monopolistic business models. They're tremendous cash cows, don't get me wrong, but they've also been able to use the financial engineering, reckless monetary policies created by the Fed, virtually free money that they could turn around. And Apple and they all did this, borrowed money, issued bonds. They didn't need money. They had more cash than they could even spend. That was their biggest problem, what to do with all our cash. And they said, let's turn around and issue bonds, and we'll use that to buy our stock back. So that's kind of created that. And that's why you have that huge disparity, if you will, between, those big Mag 8 stocks and the rest of the stock market. And this shows it. This shows that more stocks have been falling really since that point, even on this last thrust up. And that's, again, very, speaks to the longer term big picture there. Here's one I like too, a trend indicator. This is the NAHL, that's the NASDAQ new highs versus new lows. And what I do, I put a 20-period exponential moving average on that line. It's hard to see there, but that's why I created a custom histogram to show you when the two cross. So basically, in a bearish trend, the NAHL is below its 20-period EMA. So it crossed right here where that red line is, and it stayed below it throughout most of this period. And you can see that was initial leg down there, and then you've made a first crossover there. But it's a pretty decent trend indicator. It's not one of my favorites, but it's worth mentioning. You can see recently the lines crossed. That's a zoom in here. It shows you that the NAHL is clearly below its 20-period EMA right now, and that coincides. So that's just another confirming, trend indicator sell. So not a short term. These are, capture pretty good trends. Okay, I won't go over them all. I'm probably already bored you to tears already, but this last one I like. It's the QQQ, or the NASDAQ 100 up top, versus the percent of stocks in the NASDAQ 100 trading both above their 50-day moving average, that's NAA 50R right here, or their 200-day moving average. So what I do, I put a line at the 50% mark. That's what 50 is. It's, again, this is the percentage that it's trading above or below. And you can see now we're clearly below. And so the two takeaways is that's bearish when you're especially, and you got to ask yourself, guys, we just coming off new highs right there. And when we're at new highs, we already had more than half. Again, it's a breadth indicator. More than half of the companies in the NASDAQ 100, when it was at all-time highs, were trading below their 50-day moving averages. So again, that's why I was so persistent that even a breakout to new highs would only go so far, and that we'd reverse and go to the downside. And then even worse is those trading above or below their 200-day. Again, I put the line at 50, meaning if you're above this line, more than half the stocks are trading above their 50-day. And that's healthy. That's what you want to see in a healthy advance. More stocks. Come on, it's logical. Well, shouldn't more stocks be above their 50 and 200-day moving averages and an uptrend? Again, if you're in a bear market, yeah, of course they're going to be down below. You're going to see most of those below. But in a bull market, it's a red flag. That's why traders like me will look at breadth indicators to confirm, is a rally the real deal, or is there something underneath the hood that's not sounding right? Just like your car. If you're driving on the highway and you start hearing some weird sounds, clanking noise, something, you need to pull over and check it, or your car may break. Your engine may just stop running. That's what the stock market was. This showed clearly. And even look at this. Really, since that right here, this is when that last bear market hit. We went well below there. We were never able to get above there, the NASDAQ 100, the percentage of stocks. And again, this is just simply a function, and that's an unhealthy market. You can go back decades. I'm not the first to realize this, that that the sign when fewer and fewer stocks are doing all the lifting, the heavy lifting in the market, that shows you something's wrong with the economy, with the overall stock market. But the strength of those, remember, the NASDAQ 100 and S&P 500 are market cap weighted indexes. And these $3 trillion companies dwarf the other 490 stocks or 450 stocks in the S&P 500, or the bottom 90 stocks in the NASDAQ 100. They dwarf them, so they give you this false guise of a super strong, healthy stock market. Again, that index is strong due to that mathematical weighting, but Not when not when the majority of stocks for years now, last couple of years on this, especially this last thrust up, were trading below their 200. So you can see where we're at now as of yesterday's close or Friday's close. 32.77% of stocks are trading above their 200-day moving average, meaning 2/3 were trading below their 200-day and 28% on the Nasdaq or on the 50-day moving average. All right, that's it. I could beat a dead horse and go over, I have dozens of breadth and sentiment indicators, and no reason to go over them all. They're all pretty much saying the same thing. And this is credit spreads. I've been talking for a while, as a few others have, that credits. My belief is that credit was extremely mispriced. The risk credit spreads were relatively low. They've started to perk up again, and that's also a sign that you can see here. We peaked back in October of 2024. Credit spreads have slowly been rising, but still not to the point where I think they should be. And this will most likely, when we take the next leg down the stock market, you'll see credit spreads surge. What that means, that's a differential between what high quality investment grade treasury bonds are paying and what junk bonds or low quality corporate bonds are paying. And you can also just eyeball, keep an eye on. You just look at things like junk and HYD. JNK and HYD are your two big junk bond ETFs. And you can see right here, this is a level that when this breaks, a support level about 94.79. It's a pretty nice level. And you can see right now it's back testing its 200-day moving averages. Junk bonds trade more in line with equities than they do with bonds because they're priced, they're more sensitive to credit risk, things that are going on in the economy, than they are to interest rates. They already pay a very high interest rate. When you're paying 9-10%, it doesn't matter if interest rates go up 0.5%. Treasuries are going to move off that because that's all they trade on. These guys trade more on the credit quality because they're already on the verge of bankruptcy. They're just a payment or two away from, missed payment or two away from, defaulting on the bonds. That's why they're called junk bonds. They're still paying. They're still at that lowest tier of credit quality, or they're below investment grade, I should say, but they're not at default yet. But what happens is when you go into recession, and it can happen pretty quick, defaults start to surge. These guys stop paying interest, and so that's it right there. And then the price of those junk bonds plummets. That means their yields are going up. Anyway, that's a technical level to watch. I'll set an alert there, try to loop back to it. HYG is, again, just another company, another ETF company that manages those. And you can just kind of look at it, in treasuries. You can see this point here, treasuries of, this is TLT, the 30-year bond. You can see treasuries have been in an uptrend. There's that uptrend line I covered this morning. So you can see that's from the beginning of the year. Treasuries have been rising, but on the flip side, junk bonds haven't. They're back to below where, or recently at the recent lows in the stock market, below where they started the year. So they tried to go up with treasuries. And then this right here, this divergence recently is kind of the tell. And this is what smart money will look at. They look at credit spreads. To give you a clue, when is the economy really turning? The smartest of smart money out there. Most people you don't talk to at your neighborhood functions and pickleball courts or wherever you're going. These are the hedgies. These are the guys on Wall Street. These are the smart money. Will dig into the financials, the balance sheet. They know what's going in. So watch junk bonds for a clue. And so when you see junk bonds dropping and treasury bonds either holding up or going up the other direction, that means credit spreads are widening. And right now the market's not really freaking out. There's been a little uptick in credit spreads, but if they continue to widen again, that's a tell. Not good for the stock market. If they narrow, and again, these are the things I factor in. So if we happen to bounce beyond my max bounce target and credit spreads are narrowing, then it tells me that people a lot smarter than me see things that may be happening, and they'll change my positioning and outlook at that time. Okay, I'm going to wrap up here. And again, my apologies for not being able to be in front of the computer tomorrow and maybe even Wednesday if anything happens. I'm just going to tell you that I've taken even more out. And if I added it up, I might even be now at a net market negative position. I have a complex. I have individual stocks I've started shorting back into. Still got the VIX, long the VIX for the reasons I mentioned on Friday. And even though we're a little shy of my preferred target zone, nothing would surprise me. And I think like I gave you the levels today. If we get a pullback and we head up there, but I'm not married to that. That whole scenario that we must hit this level, even though it's my preferred, or may go up there. Obviously, I put higher odds that will cap, or we won't make it up there. That's why that's only the max, not preferred. But nothing would surprise me at this point, or it wouldn't surprise me if this is it for the rally. Because again, I showed you a lot of stocks below the 200-day moving averages, and a lot of evidence continuing to mount that the economy is starting to wobble, and supports the case that we're going to take another leg down. So at the end of the day, I'm very close to a diversified market neutral-ish position, because I just don't want to have any concerns of what's going to happen over the next day or two. Wish I was in front of the computer all day tomorrow, but that's it. So if we get up there, I'll have some sell limit orders firing off on some remaining long positions, and also some auto scale-ins for short positions. You just put what they call sell limit orders on a position you don't own. If you put a sell limit order on a stock you own, like QQQ, you put a sell limit right here. If you're long, it sells you out your long. If you don't have a position, depending on your broker, of course, you put a sell limit there and you don't have a position, it'll short it for you. Or if you have 100 shares of QQQ and you put a sell limit of 200, it's going to sell out your 100 long in the same moment, short an extra 100 for you. That's Interactive Brokers does that. That makes it so easy for active traders. When I talk all the time about reversing, and you have futures, if you have 10 contracts short and you want to reverse to long here, let's say you put an order, you want to go, net long 5, you just buy to cover 15 contracts there, and you hit your target, it's going to cover your short and immediately put you 5 long for the balance, or whatever your number is again. All right, guys, I'm going to stop it here, get the video out to you, and if I see anything else or you want anything else today, update on anything else that I've covered recently, the commodities or something else, individual stocks, let me know. Drop me a line in the comments section. I'll get back to you ASAP. This has been Randy Finney with Right Side of the Chart.